My name is Jason Leavitt. I started trading in late '99, went full-time in 2002. 2002 is also when I started LeavittBrothers.com, which I'll talk about later. Let me do a quick intro so you have an idea of how I trade, how I operate, so you can kind of have an idea before I get into the material I want to cover today. I'm mostly a swing trader. All my trades generally fall into two general categories. They're either short-term, where I'm in and out within a week or so, or they're longer term where I'm holding for several months or longer. The reason why my trades fall into these two groups is because I find if I'm in the middle, I end up churning my account. Okay, if a stock moves from let's say 50 to 54 and then drifts down and chops around for a while and then rallies up into the 60s, I find that you either have to be in and out on the initial move, or you have to sit tight and let it play out for several months. And if you're somewhere in the middle, you end up getting stopped out at exactly the wrong time. Okay, so that's why all my trades, before I enter any trade, I literally look at it and say, is this short term? Is this long term? Is this a trade that I want to be in and out of pretty quickly? Or is this something that I'm going to sit back, relax, and let it run its course? Okay, as Renee said, I've traded pretty much everything you can trade. But for the most part, I'm a stock trader, I'm a trend trader. I'm looking to ride trends and get the bulk of the moves. I'm not a day trader, I'm not a scalper. I want to buy a stock at 20 and ride it up to 35 in 2 or 3 months. That's a perfect trade for me. Okay. Now, when I spoke here back in September, I spoke as if it was part one of a 2-part talk. Okay, I knew since I only had 45 minutes to speak that I either had to really rush through all the material really fast, or I'd slow down and plan on doing a second talk. And without knowing if I'd be back, I decided to slow down and do service to the material that I wanted to cover and not rush through everything. So here I am for part 2 on what I call the real keys to solid profits. So before I get into my new material, I want to do a quick recap of what I covered in part 1, because I think obviously they're very related. So that's what I'm going to do first. And then once I do a quick recap of what I covered in part 1, then I'll get on to today's material. Okay, in part 1, which was recorded, and there's a video on YouTube. If you haven't seen it, if you're new here and if you didn't hear that talk, that's fine. It's on YouTube. You can either look it up, or when this particular talk is done, I'll send out a link to both part 1 and 2. Okay, in part 1, I argued that chasing consistency was a trap, that the best traders and investors are not consistent. In fact, they're the complete opposite. They're consistent with their methods, but they're not consistent with their results. Okay, I talked about, and again, this is from part 1, I talked about Warren Buffett and Charlie Munger, and how Munger admitted that if you took out the top 15 investments at Berkshire Hathaway, their performance would be average. Okay, think about that for a second. The difference between possibly being the greatest ever and just being average was only 15 investments over the course of their entire careers, and their careers have spanned 50 years. Okay, I talked about Peter Brandt and how, although he's known for averaging a 40% return for 40 straight years, his results were extremely inconsistent. He'd go several years in a row where he'd make 2%, make 3%, make 7%, make 4%, and then he'd make 300%. Okay, he protected his downside, and every once in a while he had a huge year. Okay, his average is impressive, but his year-to-year results were actually very inconsistent, and this is pretty normal among very good traders. Bill Miller, he was voted by Morningstar as the manager of the decade in the 90s. He easily outperformed the S&P for 10 straight years. But later on, he admitted that he bought Dell and AOL in the early 90s, and those two massive winners were responsible for pretty much most of his gains. Everything else was just average. Okay, manager of the decade, yet his performance was pretty much average except for those two big winners. Okay, again, he wasn't consistently profitable year after year. He just had a couple of really good ones that made up made the entire decade, I guess you can say. I talked about George Soros and how he said it was totally unacceptable to have a smaller average size position when you're right, that when you're right, you have to go for the jugular, you have to press the accelerator. Okay, virtually all traders, especially new traders, have this strong desire to be consistently profitable. They want to get to the point where they can make like 10 grand a month and be full-time, but this just isn't how the best traders operate. Okay, the essence of good trading is not getting consistent results. Okay, the best traders are inconsistent. They're consistent with their methods, but the returns are very lumpy because the market hands you unequal opportunities, so you can't expect to have a very smooth P&L curve. Okay, the essence of good trading is not having a high winning percentage. Okay, this is actually a trap. The best traders have winning percentages somewhere in the 30 to 40% range. Okay, the idea that you can get, excuse me, better and better and have a really high winning percentage, that's a trap. Okay, it's not developing a strategy that works, say, 52.6% of the time, and then you're going to execute hundreds of trades and allow the law of large numbers to work out. Okay, maybe a computer algorithm can do that. Okay, but you and I are not computers, and we can't operate like one. Okay, the essence of good trading is not making more in your winners than you lose in your losers. Okay, actually, this is partially true, but not in the way most traders think. Most traders strive to make 3 points on their winners and lose 1 point on their losers, and then they think if they execute hundreds of trades, that in the long run they'll win. Okay, but that's actually not how the best traders operate. The best traders have a few home runs that make the difference in their account. The best traders will have 10 trades, one of them will be great, and the other 9 will basically cancel each other out. Okay, the essence of good trading is, and it could be summed up in the following 2 simple statements. Number 1, preserve capital and only trade the very good setups and keep losses small. And number 2, press the accelerator, okay, when you have the opportunity. The first statement says to protect your downside. The second says to size up and maximize opportunities when you get them. Okay, the first statement says to distinguish between average trades and good trades and only do the good ones that have high potential. It also says to never let a small loss turn into a big loss. That by only trading the very best setups and by never having a big drawdown, you'll be well positioned to seize bigger opportunities. The second part says that when you get a great opportunity, it's unacceptable to only have an average size position. You must push it. You must press the accelerator. You must go for the jugular. Every once in a while, you got to go for it because one great trade could make your month or your year, whatever time frame you're looking out at. The best analogy I can offer you for what good trading is poker. Okay, and I don't like using a gambling analogy, but let me explain, and then you'll see exactly how they kind of connect and why it's an appropriate analogy. Okay, how do you play poker? Okay, you certainly don't sit down and think you're going to win every hand. Okay, heck, you don't even think you can win half the hands. Okay, in fact, most poker players sit down thinking they just need to win one good hand every hour. Okay, that's it. Okay, they think about folding when they don't have good cards and pushing it when they do. Okay, sound familiar? Okay, the game starts, and of course I'm talking about poker here, and you make a starter bet. Okay, if you're dealt crappy cards, you fold. You keep your loss small. But if you have good cards, you add to your bet. Then the dealer flips over a couple of cards. Again, based on the cards you have and the cards available on the table, you can make a decision. You either fold or you add to your bet. Even if you don't play poker, you still understand how the game works. It's such a perfect analogy. If you have good cards or sense a good opportunity, you add to your bet and keep pushing it. If you don't, you fold and keep your losses small. Okay? A good poker player will lose several hands in a row, and then boom, when he has a great opportunity, he'll strategically push it in order to win the biggest pot possible. Okay? And I think we can all agree that when you have a great hand as a poker player, it would be completely unacceptable to not fully take advantage of it. Okay? You have to take advantage of it. Okay? Trading is literally identical. Only play the best setups, keep losses small, and every once in a while when you get a great opportunity, maximize it. Okay? My guess is if you've been trading for a little while, you've made some money, you've lost some money, you've had some success, but you haven't gotten over the hump. My guess is you're pretty good at the first point I talked about. You're pretty good at protecting your downside, but you're not very good at maximizing opportunities. You see a great opportunity, you get in, you ride it, you get out, you make money, but then afterwards you say, gee, I could have made a lot more. I should have made a lot more. That's my guess. Most people, once they've been in this business for a little while, they get the part about keeping losses small, but they haven't fully embraced the idea that you have to truly go for the jugular when you're in a great situation. Okay. Stanley Druckenmiller, who traded for Soros for a number of years, said the only time Soros ever got mad at him was when he was right on a market but didn't maximize the opportunity. Okay. It would be like if you're playing poker and you were dealt pocket aces, and you win the pot, but you only won a small pot because you didn't strategically push it and maximize the opportunity. Okay, how often are you dealt aces? Like not very often. So when you get them, you have to really take advantage of it. Okay, and I realize that pocket aces don't guarantee you're going to win. There are a lot of hands that are better than pocket aces, but I think you get the point. Okay, this is what I talked about in part one. Okay, so the next logical question is, okay, that now that you understand that trading, your method has to be consistent, but your results are not going to be consistent. The next question is, how do you find the big winners? Okay, how do you and basically that's what I'm going to talk about in part two here. Okay, is that once you embrace the idea that, like, look, I'm not going to take 20 trades and have 12 winners and 8 losers and make a little bit more on my winners than I lose on my losers, and over the course of time I'm going to make money. Once you realize that instead of those 20 trades, you might only do 10 because you're going to do only the best ones. And then of those 10, you're only going to have 1 or 2 really, really good ones, and the other 7 or 8, 9, whatever they are basically going to cancel each other out. Okay, that's a more realistic situation than thinking you could have slightly more winners than losers and such. All right, so what I'm going to talk about in part two here is how do you find that 1 or 2 big winners every once in a while. Okay, first, a little background. Over time, 80 to 85% of stocks will underperform. Okay, let that sink in for a minute. 80 to 85% of stocks underperform. Okay, at first glance, this doesn't seem to make sense. You'd think some stocks would do well and some stocks would do poorly, and the market would be the average rate in the middle. But this isn't the case. Okay, because for every Netflix, and Netflix rallied 1,800% from its 2011 bottom to its 2015 top, there are 20 or 30 stocks that underperform. For every Tesla, and Tesla went from 15 to almost 300. For every Google, and Google is up more than 1,000% since going public. For every Amazon, okay, forget what Amazon's done since going public. Just in the last 8 years, it's up over 1,000%. Okay, Facebook, Priceline, the list of stocks that have done well is pretty long. Okay, for every one of these big winners. Okay, and big winners take place on all time frames. You could look at a weekly chart going back a couple of years. You can look at a daily chart going back 6 months. You could look at an hourly chart going back several weeks. You could look at a 5-minute intraday chart just covering today. Okay, for every big winner, there'll be 20 or 30 or 40 stocks that underperform. And for every stock that does really well but doesn't completely knock the ball out of the ballpark, there are still 2 or 3 or 4 stocks that underperform. All right. Let me get a quick drink. All right, let's say this is the distribution of gains and losses of each stock in the S&P 500. Okay, the average is about 12%. But as you can see, most stocks underperform, and a smaller percentage outperforms. Okay, and an even smaller percentage outperforms by a large margin. This is typical. Over time, whatever the market does, most stocks will do worse. Okay, only 15 to 20% will do better, and less than 10% will truly do great. And when a stock does worse, it doesn't mean it does poorly. The S&P could move up 10%, and you can have a bunch of stocks that move up 5 or 6 or 7%. It just means that most stocks will trade on par with the market. Some a little better, some a little worse, and very few outperform by a wide margin. This means that the only way to truly do great and nail big moves is to be in some of the stocks that outperform by a wide margin. Okay, that's the only way. Okay, and you wonder why so many funds underperform. Okay, by definition, it would be impossible to beat the market with a well-diversified portfolio, because by default, many of the stocks in the fund would be invested in stocks that don't do well. Okay, by definition, a well-diversified portfolio is pretty much guaranteed to closely match the overall market's performance. There's nothing wrong with that. Okay, but if you're striving to match the market's performance, you probably should just index your money to the S&P and be done with it. I mean, why stress? Why do the work? Just put your money in an index fund and just be done with it. Okay, but if you want to beat the market, you have to be in the stocks that are on the far right side of this histogram. Okay, to tie this in with what was discussed in part one and what I've already discussed just in the last few minutes, if you're looking for one good trade every once in a while instead of consistently average trades, then you need to be on the right side of this histogram. You need to be focused on the stocks that are outperforming, because that's where your big winners are going to come from. Okay, and I want to reiterate something. This takes, as I said before, this takes place in all time frames. Okay, if you're a day trader, you might be just looking for one good trade each day. Okay, not several so-so trades. If you're a swing trader, you're only looking for one good trade, one or two good trades every week or two. Okay, not many average trades, and so on. Okay, and the way to find these great trades is to stay on the right side of this histogram. It's to find trades among the stocks that are outperforming. Okay, money rotates around the market. Groups run hot and cold. At any given time, there will be a handful of groups doing extremely well, and almost everything else will be just on par with the market or doing worse. Okay, and groups that are hot stay hot for a while. We're not talking about day-to-day strength. We're not talking about news causing a group to perk up in the near term. We're talking about an underlying theme that persists for several months and often upwards of a year. The only way to do very well is to be in the best stocks at any given time. Okay, so how does this play out? It's kind of like this. Okay, here's a calendar. Let's say semiconductor stocks do really well for about 6 months, starting in mid-February. And while this is taking place, airlines may go on a winning streak for 8 weeks. Okay, and overlapping airlines might be biotechs, which rally hard for 3 months. And as money rotates out of biotechs, it may move into retail. And when retail loses its momentum, it may move into housing, and so on and so on. At any given time, most groups will be on par with the market, some doing a little better, some doing a little worse, and there will be a small handful of groups that are outperforming. Okay, you want to be in those groups. Okay, that's where your focus should be. Okay, you could look beneath the surface and you could use technical indicators and all that stuff, and I think everything has its place. But if your first level of attrition is let me just focus on the groups that are doing the best, then a lot of the technical indicators end up being redundant or just not needed. Okay, you can have a great signal on an average chart and it'll do average. You can have a bad signal from your favorite technical indicator from a group that's strong, and the strong group will outweigh everything. Okay, let's go through a couple of examples here. All right, this chart is a relative strength chart of energy versus the S&P 500. Okay, when it trends down, that means the group is underperforming. When it trends up, that means the group is outperforming. Okay, at the end of 2015, energy was underperforming the market. You can see that the chart was moving down. It then traded on par with the market during December, January, February, and then in March of 2016, it started to outperform. One dip to the 50-day moving average in April, and a subsequent rally confirmed that the group was going to be a leadership group, and the chart continued to trend up for a couple months. When I see this, when I see a group starting to outperform, I immediately look inside the group for trading opportunities because I know that's where many of the best performing stocks are going to be. Okay, this is what happened in the group, and I'm going to flip through a bunch of charts pretty quickly here. Okay, so remember, starting in January here, oil started to outperform. It confirmed this in March. It broke out. It confirmed it in April. And now I'm going to show you charts that from within the group. Okay, there's going to be a bunch of them. So Continental Resources during this time moved from the teens up into the high 40s, so it more than doubled. Okay, CPE more than doubled from $6-7 range up to 14. Devon Energy more than doubled from 20, 21, 22 all the way up to 40ish. ECA went up 3x. Okay, choppy trader after it got going, but really good overall move. Okay, EEP moved from mid-teens to the mid-20s it didn't double, but it did pretty well. EGN moved from mid-20s up into the 50s, so it doubled. ERF, and I'm going to go through these quicker because I think you're getting the point. ERF went from 253 all up to 750, so it about tripled. Diamondback Energy didn't double, but it did really well. Laredo went from $4 or $5 up into the teens, up to almost the teens. It went up to 11, $12. Oasis went from 4.5 up to 10ish area. Parsley Energy more than doubled from the high teens into the 30s. QEP went from like $10 up to 20, so it doubled. Rice Energy went from like $10 up into the 20s for it more than doubled. RSP Perriman went from 20 up to 40. I'm going to go through these, just a couple more here. And then WLL went from like $4 up to the 14 and more than tripled. Okay, WPX went from 4 up to like $10 before it consolidated and broke out again. Okay, so again, during a time period when energy was outperforming the S&P, okay, during the time when this is a time when energy was on the far right side of that histogram chart that I showed you earlier, many of the stocks in this group doubled or tripled. Okay, here's the S&P during that same time. Okay, it rallied 20%. Okay, I say it only rallied 20%, but I mean that's kind of a joke because that's an incredible move for the entire market. But by identifying a group that was outperforming and then looking inside the group for opportunities, there were numerous big moves to be had. Okay, the S&P moved 20%. You identify a group that's outperforming, and then there are many stocks within the group that do significantly better than 20%. All right, let's look at another example. Here's the relative strength chart of gold versus the market. Okay, at the end of 2015, where's my cursor? There it is. And beginning of 16, gold stocks traded on par with the market. Okay, then starting in early January, where the relative strength chart broke out, it came back down to test its 50-day moving average in January, and then it moved higher and continues to outperform throughout the summer. Okay, this is what took place in the group. And again, I'm going to flip through a bunch of charts relatively quickly here. Okay, so ABX moved from like $7-8 up into the 20s, so it about tripled. AEM moved from mid-20s up to 60, so it doubled. First Majestic Silver went from $3-4 up to almost 20 for a huge percentage move. AU went from 8 up into the 20s, so it almost tripled. AUI went from under $2 up to 6. BVN moved from $4 or $5 up into the mid-teens, so it tripled. And it goes on and on. I'll just flip through these. You can see them. CDE, 3 to 15. EXK 1.5 up to 5.5, and it goes on and on. Okay, you guys get the point. Newmont Mining, big stock, S&P 500 pays a dividend. Even it more than doubled. Okay, so it's not just like little companies that are really sensitive. It's bigger companies too. Okay. Nugget is the leveraged ETF, went from 20 or 30 up to like 180, so it's almost like a 9x return. Silver stocks also did well, 6 up to Pan American Silver, went from 6 or 7 up to 2021. Royal Gold, same thing. Richmond Mine, same thing. Silver Wheaton, same thing, went from 20 up to 30, so tripled. Silver Standard, $5 up to 15, it tripled. Okay, so again, this is an example of a group that was on the far right side of the histogram. Okay, it was a group that was outperforming by a wide margin. Okay, but I want to point out something that I pointed out with the oil stocks is like, here's the S&P 500 during the same period. It went up 20%, which is a great move for the overall market, but many of the gold and silver stocks went up 200 and 300%. Okay, that's what you're shooting for. You identify the groups that are leading, and then you dig into those groups to find your trades. Okay, let me go through one more example. Here's Semiconductor. Here's a relative strength chart with semiconductor stocks versus the S&P 500. Okay, remember, gold started outperforming in January, energy started outperforming in March, and here are the semiconductors. Okay, they started outperforming in late May, early June. Okay, and then they confirmed in early July on that little dip to the 50-day moving average. Okay, and again, I'm just going to flip through a couple charts here. Okay, so ADI moved up nicely, AMAT steady trend. Advanced Micro Devices was a big winner for us. Avago, harder to trade because it's kind of choppy, but the overall trend was in place. Micron, nice steady trend. NVIDIA, really nice action. Okay, so earlier I said the 2 keys to really making it as a trader were, number 1, preserve capital and only trade the good ones and keep the losses small. Okay, this protects your downside. And 2, press the accelerator. This means when you get a great opportunity, you have to somewhat shoot for a bigger gain. Okay, you don't want to be a poker player who is dealt pocket aces and then only wins a small pot. Okay, the first step in pressing the accelerator is to identify the groups that are outperforming. Okay, it's to find the groups that are on the far right side of the histogram chart that I showed you earlier. Okay, those are the groups that will offer the biggest moves. Those are the groups that you can size up a little bit. Okay, those are the groups that will be more forgiving. Okay, a strong group will help your winners do even better, and they'll help you rescue some of your bad trades. Okay, that's what you want. You want the wind kind of at your back. Okay, so the next question is, how do you identify the best groups? Okay, and that's what I'm going to talk about next. All right. It's not that hard, okay? It's not rocket science. You certainly don't need access to any charting service that or anything that isn't available on isn't easily accessible online. Okay, I have two general approaches. One is a top-down approach, one is a bottom-up approach. Okay. And I do both. I do more of the bottom-up approach. I'm going to go through both one and give you some examples. And again, your only goal here is you want to identify the groups that are outperforming by preferably by a wide margin, and then you want to drill down into those groups to find your trading opportunities. Okay, you have the entire universe of stocks, and there are thousands of stocks. Instead of just looking at all of them and applying some sort of technical indicator and saying I'm only interested in stocks where the MACD is doing X, or I have a certain count with Elliott Wave, or the stochastic is doing some certain thing. My recommendation is to first identify the groups that are doing the best, and then apply those technical indicators, whatever ones you like to use, apply them to the groups that are doing the best, apply them to the stocks in those groups, because that's where your bigger moves are going to come from. Okay, as I just showed with the semiconductor stocks and energy stocks and gold stocks, if a group is doing really well, you could almost close your eyes, buy any 5 stocks and do well. Whereas if you play a group that's just doing so-so, that individual stock has to be really, really strong. Okay, and research shows that most of a stock's movement is based on the overall market and the group that it belongs in. It's not based on the individual stock itself. Okay, if you individually have a great company like a Netflix or an Apple or an Amazon, then fine, those stocks can go on their own. But most stocks need peer support. They need support of the market. They need support of stocks in their group. And so that's like the first thing you should do, is let me identify the best performing groups, and then I'm going to apply whatever my favorite technical indicators are to the stocks in the group. Okay. So the first thing I do is I'll look at sector rankings. Okay. Here's just a quick snapshot. I have a subscription at stockcharts.com. If you don't, it's fine. You don't need it. But it's a great charting service. And so I have a folder in there, or a watch list, I guess you can call it, with 160 groups, and I look at it every day. I look at it and I could sort it based on performance, as you see here. And this is not any type of live update or anything. It's just a screenshot I grabbed a while ago. And so I could sort it based on what groups are doing, what groups did best today, what groups did best over the last week, over the last 2 weeks, over the last month, 3 months, whatever they offer, and it'll give me an idea of what groups are doing the best at any given time. And when I see groups constantly that are constantly near the top of the list, those are the groups that I'm going to look into. Okay, again, I don't want to go look at random stocks. I want to look at the groups that are doing the best, and then I want to look inside those groups to find my trading opportunities. Another website, if you don't have a subscription to Stock Charts, you can use Big Charts. It's an older site that doesn't get used very often, but they still have industry rankings. Okay, as you can see here, this is just a list of industries, and you can see I have it sorted by 1 week. You can change it. I don't remember exactly what, to 2 weeks, to 1 month, 3 months, year to date, whatever you want, to get an idea of what stocks have done the best over the course of a certain number of over time. Okay, and again, find the best groups, look inside. Another service I like, barchart.com. I don't subscribe to it. They have a lot of stuff for free. They have their own rankings. Okay, with Stock Charts and Big Charts, they just rank based on performance. If a group is up 10%, everything else is doing worse, then it's going to be at the top of the list. Barchart has its own technical analysis, and it ranks slightly differently. Okay, so there's a lot of crossover between the lists, but sometimes you get a little different view from bar chart. And another good thing about bar chart is, like, you can click on one of these headings and you can get a list of stocks within the group. So again, it's good. You look at this, you get a list of what groups are doing best. You can click on the group and get a list of stocks, and boom, right there, instead of considering several thousand stocks to trade, you've already in just a matter of minutes, you've narrowed down the list to just maybe a couple hundred at most. All right. So another method I use is monthly and weekly charts. Okay, a lot of the assumption is that as a technical analyst, as a technical trader, the assumption is I'm looking at like the 5-minute chart with some indicator, or maybe the 60-minute chart or something like that. The reality is I look at the monthly and weekly charts a lot. I use the monthly chart with a 10-month moving average. I use a weekly chart with a 30-week moving average. They tell me a lot. They tell me which groups are doing the best, which groups are basing, which groups are, they don't tell me if they're underperforming or outperforming, but they tell me which ones are trending, which ones feel safe to be in. And so two different things I look for is I look for continuation patterns and I look for groups that are coming out of bases. Okay, continuation pattern is going to be a group on the monthly or weekly that did very well, then moves sideways for many months, maybe even a year, and then starts to trend up again. Or I look for ones coming out of a base, and that's going to be a group that trended down for a year, 2 years, maybe longer, forms some sort of a base, and then jumps above a key moving average on a lot of volume, and that tends to change the tide. Let's go through a couple of examples here. So here's a monthly chart of auto parts. Okay, so it trended up 2013, early 2014, then it traded sideways for, I don't know, what does it look like, about 9 months, and then it broke out and traded up again. Okay, so I'll flip through all the groups, and when I see a group like this that was consolidating and then move up and then starts to move up again, I look at it closer. Okay, it doesn't mean this group is outperforming, okay, because maybe the S&P 500 is, even though this one is doing well, maybe the S&P 500 is doing even better, but it does clue me in that, like, hey, at least this is a place you should look. Here's the drug group, and I'm just posting this as an example of a group that traded very calmly, very safely, that offered a lot of entries, that offered a lot of safety, because when the group is doing this well, you could dig down into the group, find some good stocks, and you could feel safe that you could buy them on dips. Okay, there's some stocks that are really volatile and you want to buy a dip, but when it actually dips, it's kind of scary. But when the monthly chart with the 10-month moving average is slowly moving up like this, that gives you a feeling of safety and security. Okay, it might be, it's a place to look. Okay, there's no guarantee here. This could be going up at a slower rate than the S&P 500, so it might not necessarily be outperforming, but it at least gives you an idea that, hey, this is a place to look. Okay, here's an example of gold through 2012 through the end of last year, towards the end of last year. Obviously it trended down for many months. Then you can see here in early 2016, huge up candle, huge volume. Okay, that's a game changer. When I see that, I immediately look inside the group and think like there's got to be some stocks that are tradable. Okay, and that's and if you think back to the relative strength chart from, I don't know, 15, 20 minutes ago when I was talking, when you get a combination of like, hey, the relative strength chart is starting to turn up, or the gold stocks are outperforming the market, and then you get a massive candle here on big volume, that's a good 1-2 punch. I immediately look inside the group for some entries. All right. All right, here's oil and gas, drilling and exploration. Traded flat 2012, 2013, 14, trended down for a year and a half, got rejected here by its 10-month moving average. Then it gets above the moving average. Volume is pretty good here. When I see that, I wonder if the tide is changing. I'll look inside the group. I'll look at the relative strength chart. This is a great situation because some groups they go up and up and up and they look really good, but they've gone up so much you wonder how much more they can go up. When I see a group that's beaten down like this and then gets above a key moving average like the 10 on the monthly chart, I look inside the group, look for some trading opportunities. Okay, it's a good place. Here's another good one. Steel and iron traded flat, trended down then for 15, 16 months or so, gets above its 10 moving average on big volume. Notice here then it consolidates for a couple months. Notice the 10 is starting to curl up, and then boom, we start another uptrend. Okay, it's another great chart. Okay, it's something like steel and iron is like cyclical. It's going to go up and down. It's probably not going to just trend indefinitely in one direction. So when I see it on the monthly chart get above a key moving average and then consolidate and then start legging up again as the key moving average starts to curl up, I immediately look inside the group and look for some trading opportunities. Okay, and again, the whole point here is if you want to be on the right side of that histogram, you want to be on this in the groups that are outperforming by a wide margin. I'd rather buy a steel stock, which is in this phase over here these last couple months, than to randomly go into any group and say, hey, the MACD on this particular chart is turning up, so I'm going to buy it. I'd rather buy a steel stock where the MACD is turning up, because a steel stock is in this group, and this group is like up and coming. All right, so the next thing is relative strength charts. Okay, you're already familiar with those. I showed you the relative strength chart with energy and gold and semiconductors. Okay, the monthly and weekly charts tell you what's doing well, but they don't tell you if they're doing much better than the market. The relative strength charts will tell you which ones are actually doing better than the market, and that's what you want. Okay, if your goal is to match the market's performance, there's nothing wrong with that. But why stress over buying individual stocks? Just put your money in an index fund and be done with it. If you want to actually beat the market, like by definition, you have to be in the stocks that are on the right side of that histogram. You have to be in the stocks that are outperforming by a wide margin. So I look at the relative strength charts. Let's look at a few examples. You've already seen some. Here's an example of the defense industry versus the S&P 500. It traded flat during this time period, then it gets above the 50-day moving average and starts trending up. So during this entire time, you could feel somewhat secure that the market's doing X and this group is doing better, so this is a group that I want to be focused in. Here's one that's trending down. You have auto parts stock. Obviously was weak. They were weak during this time period, fell hard here. For a couple months, they actually traded on par, maybe a little bit better, and then they broke down again. So if I'm looking in the auto parts stock group and I see a couple charts that look really good, but this is the relative strength chart, I could still play those auto parts stocks, but those are going to be quick trades. I'm going to get in, I'm going to get out within a week or so. I'm not looking for a home run. I'm not looking to size up. I'm just not looking to take on a whole lot of risk, because I know that the group isn't doing that great. It's doing okay, but not that great. So I got to keep stops tight and just shoot for like singles and stuff. Okay. Another example, and I see this all the time. It's similar to, I showed you the monthly charts where a group would underperform for a while and then it would get above its key moving average on big volume, and that kind of turns the tide. Here's an example of a group that trended down for many months. The group didn't necessarily trend down, but it was underperforming for many months, and then out of nowhere it surges above its 50-day moving average, and that kind of turns the tide. So if this relative strength chart can consolidate here and then move up again, this would be an example of a chart that was in the middle of the histogram, or maybe on the left side of the histogram, and now and after this happens, it's moving to the right side of the histogram. And as money rotates around the market from one group to another, this is an example of a group that was out of favor, and now it's come into favor. All right. All right. So, and then the last one is my bottom-up approach, which just entails a lot of grunt work. Okay. And this is the one I prefer just because I'm used to it. And what this entails is just looking at a lot of charts, pulling out the stocks that look the best, and then literally just observing which groups are most represented. If I look at every chart in the S&P 500 and I pull out the 30 or 40 or 50 best looking charts, and I realize that, like, gee, 6 of these are semiconductor stocks, that makes me, you know, obviously semiconductors are doing fairly well, and I'm going to look within the group for other semiconductor stocks. Okay, I kind of prefer this for one, because it gives me a better feel for the market. Is what I'm used to. I've always liked looking at a lot of charts. The other reason I kind of like I like a bottoms-up approach is that it clues me into what the up and coming groups are going to be. Okay, so like for example, you may have semiconductor stock 1, starts to move up, and then 2 weeks later, semiconductor stock number 2 starts to move up, and a week later, semiconductor stock number 3 moves up. Then the relative strength chart might turn up and get above its 50-day moving average and start trending, and then after that, like boom, 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 other charts follow. So if you only look at the relative strength chart, you miss those first 3 or 4 movers, and those first 3 or 4 are already, they've already moved up 10 or 15%, and you've already missed, the entry by several weeks or longer. And that's fine, because groups tend to run hot and cold, and when they're hot, they tend to stay hot for for several months. So it's not, you miss maybe the first month or so of a 6-month move. It's not a big deal. But I kind of, when I do a bottoms up approach, it gives me clues as to what the up and coming groups are going to be. You can have a group that's beaten down, but very quietly a couple of stocks start to move up, and it kind of clues you in that like, hey, this group might be turning the corner here. Okay. So those are the two ways that I find the groups. Okay, top-down approach entails identifying the strongest groups and then looking inside the groups for the best-looking stocks. The bottom-up approach should actually be like a bottom-up / top-down, because I look at a lot of charts and then I find the best-looking groups from those charts, and then I turn around and go back into those groups to find more plays or better plays. All right, so to kind of sum up everything here. In part 1, which again, I recorded, here, I think it was back in September. Okay, my goal was to convince you that chasing consistency was a trap, that the best traders and investors are like poker players. They fold and keep losses small when they don't have good cards. But when they sense an opportunity, they strategically push it and win as much as you can. Okay, again, if you've been trading for a while and you made some money, lost some money, but you haven't gotten over the hump, I'm guessing one of the reasons why is because when you have a really good trade, you probably just manage it like you do everything else and you make money, but then afterwards you look at it and say, you know what, I could have made so much more. Okay. Every once in a while, when you really do get a great opportunity, like a poker player, you have to strategically push it to win a big pot. Because the reality is all good traders have home runs once in a while that actually comprise the bulk of their gains. Okay, today in part 2, I dug a little deeper and explained how to approach the market with this mentality, that if you have a diversified portfolio, you are guaranteed to match the market's performance, and that if you want to outperform, okay, if you want to nail that big one every once in a while, the best way to do it is to first focus on the stocks that are outperforming. Focus on the stocks on the right side of the histogram chart that I showed you. Okay, running out of time here. If I get invited back for a part 3, I think it would be logical to actually talk about entry techniques, trade management, exits, and stuff like that. Okay, there's just too much to power through in just 45 minutes. Okay, so that's pretty much all I have. Just got a minute here. I'll tell you about my service, and then I'll open up the floor to questions. Okay, so I'll briefly talk about Leavitt Brothers here. The service was started in 2002, so this is our 15th year being in business. Okay, we offer market analysis and trading ideas to hedge funds, individual traders, financial planners, and such. Okay, more specifically, we have daily and weekly reports which discuss the trends and the staying power of those trends. Okay, the trend really is your friend. Okay, it's a cheesy cliche, but it's absolutely true. Okay, for most traders, if they just position themselves in the direction of the trend, most of their hard work would be done. Okay, we're totally objective. We have no agenda. We call it as we see it. And since we've been in the business for 15 years, that's pretty good evidence we must be doing something right. Okay, with trading ideas, our focus is to find the groups that are outperforming and then to drill down into those groups and find the best opportunities. Okay, this is what I've talked about today, finding the groups on the far right side of the histogram and then drilling down and finding your best opportunities. Okay, LeavittBrothers.com offers all that for one subscription price. This is the business that's been in business for 2002, weekly reports, daily reports, trading ideas. We have a message board. It's a lot of stuff. Okay, it's available for one subscription price. LeavittBrothers.net is the same service, but it's unbundled. Okay, over the years, we've had a lot of subscribers tell us that they love our reports, but they trade differently than us. Others have told us that they don't want the reports. They just want a list of the stocks that we're focused on. Okay, and we kind of get that. They have other analysis that they're looking at. Like all they want is a list of our stocks. So we launched LeavittBrothers.net to give traders and investors an opportunity to subscribe to just what they wanted to. So that's all I have. Thanks for being here. Thanks for listening. And with that, I see there's one question here. Do you buy long or short? Do I buy long or short? The reality is the market trends up a heck of a lot more than it trends down. I mean, I started the service in 2002, and other than the tail end of the .com bubble bursting and during the financial crisis, which actually didn't last as long as it seemed if you watch the news, the market has been trending up for like 90% of the time. So I'm not against going short, but the reality is most of the money is made going long, and that's my focus. When the market is trending up, I'm either long or on the sidelines. I'm usually not short. So if the market trends up, pulls back, and then trends up, I'm not going to go long, then short, then long. I'm going to go long, scale back, get ready to go long again, and then go long. The reason why is because if I start going short, then I start defending short positions. I start talking about like you got to be short in order to make money, et cetera, et cetera. And then when the market starts going up, I end up missing it because I'm biased towards the short side. I'd rather look at the long-term trend. If it's up, I'm going to be aggressively long or much less aggressively long, but I'd rather have a long bias than anything else. So I'll go short, but the reality is you can make a lot more money going long, especially when the market's trending up.